how does a $14 billion credit fund actually make money when their borrowers, just stop paying their debts?
Right. It seems completely counterintuitive.
Exactly. Well, today we are ripping apart the Q1 2026 SEC filings for one of the biggest players in the space to show you how corporate defaults, ironically, are sometimes exactly the operational leverage they're looking for. Welcome to the deep dive.
We've got a really massive stack of materials on the table for you today.
Oh yeah, it is dense. We are specifically focusing on the Blackstone Secured Lending Fund, ticker symbol BXSL, and we're pulling directly from their Q1 2026 earnings report, the live earnings call transcript.
Right, the one featuring co-CEO Brad Marshall and CFO Teddy Desloge.
Yep, that's the one. Plus their Q1 slide deck, and of course the official SEC 10Q filing under accession number 00173603526000000.
It is a seriously heavy stack of disclosures, but, if you look past all the standard regulatory boilerplate, you find an absolute masterclass. It shows how modern, highly structured corporate lending actually operates behind closed doors. We are basically looking at a master blueprint for navigating severe market turbulence.
Yeah, and executing some pretty aggressive corporate restructurings.
Here we go.
Not to mention financing the physical infrastructure of the AI revolution.
Exactly.
So the mission for you listening today is to decode that exact blueprint. We really want to understand the underlying mechanics of private credit when the macro environment gets, well, choppy. So, okay, let's unpack this. We should start with the sheer scale of the defensive structure Blackstone has built here.
Right, the numbers are just staggering.
They really are. In the first quarter of 2026, BXSL generated 77 cents per share of net investment income. And they're paying out exactly 77 cents in their dividend.
So 100% coverage ratio.
Exactly. And that translates to an 11.7% annualized dividend yield based on their net asset value.
Which is wild.
Yeah.
But, the yield is just the headline. The underlying architecture is what actually matters here. 97.6% of their investments are first lien senior secured debt. And that's spread across 316 different portfolio companies.
Wow, so heavily diversified.
Very. And their average loan to value sits at 51.7%. Plus, and this is crucial for the current macro environment, 95.8% of that debt is floating rate.
Okay, so let me just visualize this. I think of that 51.7% LTV like having a VIP pass to the lifeboats on a sinking ship, plus a massive buffer before the water even reaches your deck.
I love that. Yeah.
Like if a portfolio company is valued at $100 million, Blackstone has only extended about $51 million in debt. So the broader market valuation of that company has to compress by literally wiping out the entire equity tranche below them before Blackstone's core loan principal is even threatened.
The lifeboat analogy works perfectly because, financial architecture is literally designed to absorb impact. And that floating rate component you mentioned, that's their secondary shock absorber. Because the base rate floats as the Federal Reserve keeps rates elevated to battle sticky inflation, Blackstone's interest income automatically adjusts upward. So they are totally shielded from the duration risk that absolutely crushes fixed income bondholders when the yield curve shifts.
Okay, but I'm looking at the balance sheet in this 10Q, and I have to push back a little on the idea that this armor is impenetrable.
Oh, sure. Go ahead.
Well, Blackstone claims the structure protects capital, yet their net asset value dropped by 2.5% this quarter. It landed at $26.26 per share. And management basically blames it on market anxiety and spread widening.
Right.
But isn't that incredibly convenient? If credit spreads are widening across the leveraged loan index, the market is pricing in a genuine increase in default risk. At what point do we stop calling it market vibes and start calling it fundamental deterioration in their borrowers?
Well, what's fascinating here is the mechanical disconnect between secondary market bond math and primary market cash flows.
What do you mean?
So the NAV drop you're seeing is really just a function of mark-to-market accounting. During Q1, broader leveraged loan index spreads widened by roughly 50 basis points.
Okay.
And bond math basically dictates that when investors demand higher yields, the paper price of existing loans must drop to match that new yield profile. Consequently, BXSL's portfolio average mark fell to 96.2 cents on the dollar.
I see. So the market is effectively discounting their assets because liquidity providers are demanding a higher premium for risk across the board.
Exactly. But you have to look at the fundamental cash flow metrics of the underlying borrowers to see why management views this as a paper loss rather than a realized impairment.
Okay, lay the numbers on me.
Well, the underlying companies in that 316 borrower portfolio are printing stable, high single-digit EBITDA growth. And furthermore, their average interest coverage ratio is 2.0x.
Wow, okay.
Yet these companies are generating twice the operating cash flow required to service their debt, even at these elevated floating rates. So the interim marks reflect institutional liquidity premiums, not an inability of the borrower to actually make their quarterly cash interest payment.
Okay, that makes sense. But that 96.2 cent mark is just an average. If we zoom in on the extreme left tail of that bell curve, we see the companies where the market anxiety actually materialized into a genuine cash
Right,
crisis.
the ones that actually took on water.
Exactly. The 10Q shows non-accruals, basically the defaults rising to 3.1% at fair value.
And this is exactly where the theoretical protections of private credit are tested against reality.
Yeah, and we have three new additions to the troubled list this quarter. Let's list them out. First is Medallia, an enterprise software company, marked down to 60.3 cents on the dollar.
Ouch.
Yeah. Then Affordable Care, a massive dental services business, marked at 69.8. And Paramount Global Services, a building products distributor, sitting at 65. Just these three additions constitute 88% of the fund's non-accrual fair value.
That's highly concentrated.
It is. And, when a traditional syndicate of like 50 different banks sees a default like this, it is an absolute chaotic scramble for the exits.
Oh, absolutely. Because a broadly syndicated loan relies on consensus among dozens of participants, and they all have conflicting incentives.
Yeah.
But direct lending strips out the syndicate entirely.
Right.
Blackstone Credit and Insurance BXCI, they act as the sole or lead lender in nearly 80% of their historical exposures. They control the voting rights. They dictate the timeline.
Yeah, and when Brad Marshall was discussing this on the earnings call, it sounded less like a panic or a crisis management response and more like a really aggressive, distressed real estate play.
Yes.
It's like flipping a house, but applied to corporate capital structures. The borrower defaults, so Blackstone just takes the keys, fires the property manager, guts the plumbing, and engineers a turnaround.
That is a brilliant way to put it.
But you can only execute that if you have an ironclad mortgage agreement, right?
Which they do. The credit agreements are basically weaponized. Teddy Desloge, the CFO, noted that nearly 100% of BXCI-led deals feature enhanced protections.
Wow.
Yeah. Compare that to the broadly syndicated market, where only 40% of loans have those covenants. We are talking about strict barriers against asset stripping and hard caps on EBITDA add-backs.
Let's drill into that for a second, because asset stripping is exactly how private equity sponsors usually burn lenders in a distress scenario.
Right, the classic traps.
Exactly. They use the J.Crew loophole. A company is bleeding cash, so the sponsor quietly transfers their most valuable intellectual property, like their brand, trademarks, into an unrestricted subsidiary. Then they borrow fresh debt against that IP, effectively moving the core value of the company completely out of the reach of the original First Linden lenders.
It's a nightmare for traditional lenders. But Blackstone's credit documents explicitly block those trapdoors.
So they just shut it down.
It's exactly. By closing the unrestricted subsidiary loopholes, the private equity sponsor literally has nowhere to hide the collateral. And the same logic applies to capping EBITDA add-backs.
Right, because sponsors love to inflate their earnings, don't they?
Oh, they love it. They claim millions of dollars in expenses are just one-time restructuring costs that should be added back to EBITDA. But Blackstone caps those adjustments. The numbers have to reflect the harsh reality of the business, which triggers default covenants earlier.
And when those covenants trip, Blackstone steps in to force a resolution. They either compel the private equity sponsor to inject fresh equity capital to cure the default, or they orchestrate a restructuring that completely wipes out the junior debt and preferred equity layers beneath them, basically taking full operational control of the asset.
Yeah, and the historical performance data on this specific playbook is just staggering. Across 20 years and $160 billion deployed, BXCI has realized less than 10 basis points of annual net losses.
That's almost zero.
It is. Consider the restructurings within BXSL itself. Of the fully realized restructurings they have navigated since inception, they achieved a 0.98x multiple on invested capital.
Wait, really? So even in a catastrophic downside scenario where the borrower completely fails and the capital structure has to be torn down to the studs, they still recover 98% of their invested capital.
Yep. That factors in the penalty interest and the restructuring fees they extract during the workout process.
That is wild. They essentially force the borrower to pay for the cost of its own rescue.
They do. Which brings us directly to the strategy behind Medallia.
Right, the software company on the non-accrual list.
Exactly. as the largest single contributor to the troubled list, making up 1.7% of the fund's total fair value.
Mhm.
The restructuring of Medallia isn't just a defensive maneuver to stop cash burn. They are intentionally deleveraging the balance sheet to free up free cash flow for aggressive product reinvestment. And the specific product Medallia needs to invest in is artificial intelligence.
Okay, here's where it gets really interesting, though. The AI transition is carving a massive divide through their portfolio.
It's totally reshaping it.
BXSL Software Book represents about 70 companies with average revenues exceeding $750 million. But in Q1, that specific sector took a brutal 270 basis point markdown. And management explicitly stated this valuation hit wasn't due to poor current earnings.
No, not at all.
It is purely the market pricing and the existential threat that generative AI poses to legacy software as a service business models.
Right. The secondary market is projecting forward. They're evaluating a traditional SaaS platform and questioning whether an AI agent will simply replicate that exact workflow for a fraction of the cost within 24 months. That terminal value risk is immediately reflected in the debt pricing.
But the strategy presented in the slide deck seems wildly contradictory to me.
How so?
Well, on one hand, Blackstone acknowledges that AI is an existential threat to their massive legacy software portfolio. Yet simultaneously, they are aggressively financing the exact AI infrastructure that will accelerate this disruption.
Ah.
Like, why would a lender provide $10 billion in GPU-backed debt financing to a cloud provider like Firmus Technologies? They are literally funding the asteroid that is actively targeting their own dinosaurs.
That's a fair point.
And from a pure credit perspective, lending $10 billion against physical NVIDIA GPUs seems reckless. Hardware depreciates aggressively. By year 3, those chips are obsolete. How do you underwrite a senior secured loan against depreciating hardware?
Well, if we connect this to the bigger picture, the collateral isn't just the resale value of the silicon. It is the contracted cash flow attached to the compute power.
Oh, I see.
Yeah, Firmus isn't buying GPUs on speculation. They're deploying them against massive multi-year hyperscaler compute contracts. Blackstone structures the amortization schedule of the debt to match the guaranteed cash flows from those contracts, ensuring the loan pays down faster than the hardware depreciates. And of course, they hold a first lien on the physical assets as a backstop.
Okay, so it operates much closer to project finance for like a toll road than a traditional corporate loan. The revenue stream from the cloud compute pays down the principal before the GPUs become obsolete.
Precisely.
Yeah.
And across the wider Blackstone platform, they have anchored nearly $25 billion in these GPU financings. But they aren't merely acting as a passive capital provider for the disruption.
Right.
They are engineering a closed-loop ecosystem. They take the insights and partnerships generated from financing the AI infrastructure and actively deploy them right into their legacy portfolio.
Ah, and the Anthropic partnership is the bridge here, isn't it?
Exactly.
Blackstone didn't just write a check to Anthropic. They partnered with them to build a dedicated AI deployment firm. They're bringing in heavy hitters like Rodney Zemmel, the former global leader of McKinsey Digital, to act as an internal strike team.
Just think about the operational leverage that provides. Going back to Medallia for a second.
Yeah.
Blackstone uses their ironclad credit agreement to force a restructuring. They wipe out the junior debt, eliminating a massive chunk of interest expense. This frees up operational cash flow. Then they parachute Zemmel and the Anthropic partnered engineering team directly into Medallia to fundamentally rebuild the company's tech stack.
Wow. They literally use the technology they're financing on the infrastructure side to inoculate the software portfolio they're currently holding on the lending side. It's an insanely aggressive, proactive defense mechanism.
It really is. But it also perfectly illustrates the friction between interim valuations and actual realized returns.
Right.
The market marks down the Medallia debt or marks down the broader software portfolio by 270 basis points based entirely on AI anxiety. The listener looking at their brokerage account just sees the NAV drop.
Right.
But the critical mechanism to understand here is how a private credit investor actually realizes cash returns despite those depressed paper marks.
And that is the repayment engine. Looking at the Q1 slide deck, the volume is massive. BXSL recorded nearly $450 million in loan repayments in the first quarter alone. And as Loj noted, they have line of sight on over $600 million in repayments for Q2.
The repayment mechanism is fascinating because it exploits the spread between the secondary market paper mark and the primary market legal contract.
Yeah, I view this through the concept of a rubber band. So you have an asset in the portfolio that is fundamentally performing, revenue is stable, EBITDA is growing, But because the broader leveraged loan index is seeing spread widening, or there's sector-specific AI anxiety, the mark-to-market accounting stretches the value of that debt down to 80 cents on the dollar on Blackstone's books.
The rubber band is pulled taut.
Exactly. However, the legal credit agreement still dictates that the borrower owes the fund exactly 100 cents on the dollar.
So what triggers the release of that tension? Corporate actions.
Right.
A private equity sponsor decides to exit their position and sells the company to a strategic buyer. Or the company initiates an initial public offering. To clear the balance sheet for the transaction, the existing debt facilities must be retired. And they are not retired at the market's anxious 80-cent valuation. They are paid off at par.
The rubber band snaps back violently. The discount is instantly converted into realized capital gains for the listener's portfolio. And the earnings report is packed with data proving this exact dynamic.
Let's hear some examples.
Take AEVX Aerospace. This was a position that experienced fundamental underperformance early on, and Blackstone was forced to mark the debt all the way down to 82.5 cents. But the company corrected course, executed an IPO in April, and retired the BXSL loan at exactly 100 cents on the dollar.
And that wasn't an isolated event. SelectQuote was marked on the books at 88.4 cents. It was fully repaid at par in Q1. Colony Hardware was marked at 91.75 cents, repaid at par.
Wow.
Alliance Grounds not only repaid its senior debt at par, but the equity kicker that Blackstone negotiated into the original deal returned a 2x multiple on invested capital.
That's incredible. Those four companies alone generated over $300 million in par repayments from assets previously marked in the 80s and low 90s. The strategy is so clear, they heavily document the downside protection, collect the 11.7% yield while the market panics, and simply wait for the corporate transaction to trigger the snapback to par.
Yep.
But this creates a totally new mechanical challenge. With $450 million incoming in Q1 and another $600 million projected for Q2, Blackstone has over $1 billion in cash looking for immediate deployment.
True, but this is where their historical outperformance becomes a strategic weapon for capital allocation. Because BXSL has consistently out-earned its base dividend payout, they've accumulated roughly $1.80 per share of undistributed net investment income. It acts as a massive liquidity reservoir. Teddy Desloge outlined exactly how they can deploy this capital depending on where the market anxiety shifts next.
Okay, so option one is straightforward reinvestment. If spreads remain wide because the market is still demanding high liquidity premiums, Blackstone takes that $1 billion in repayment cash and underwrites brand new first lien loans at even higher yields, locking in better risk-adjusted returns for the next cycle.
Precisely. And option two targets the dislocation in their own stock price. Because BXSL shares have occasionally traded slightly below their fundamental net asset value, again, driven by broader market sentiment, the board authorized a $250 million share repurchase program.
And the math on that is beautifully simple. If the stock is trading on the open market at $24, but the underlying assets, after accounting for the par repayments and the 98% recovery on restructurings, are mathematically proven to be worth $26.26, executing a buyback is a completely risk-free, instantly accretive return for the remaining shareholders.
Absolutely.
They literally buy a dollar's worth of highly protected assets for 90 cents.
It perfectly encapsulates the structural advantage of having locked up long-term capital in a volatile macro environment. They are never forced sellers. They only transact when the mechanics explicitly favor the portfolio.
So, what does this all mean for you listening to this deep dive? Understanding Blackstone's Q1 earnings report requires looking way past the ticker symbol or the dividend yield. It requires a fundamental shift in how you analyze corporate debt.
Yeah, you have to look under the hood.
The architecture of a true direct lending fund relies on massive 50% equity cushions to absorb valuation shocks and draconian credit covenants to prevent asset stripping. They use market volatility as a mechanism to extract wider spreads, and they use corporate defaults as leverage to assume operational control.
Right, and in a market environment dominated by extreme stock market whiplash and aggressive sector rotations, a portfolio generating double-digit embedded current income, backed by 98% first lien positions, operates as a profound structural shock absorber. It strips out the noise of the secondary market and focuses entirely on the contractual cash flow of the underlying businesses.
Exactly. They aren't trying to predict the macroeconomic weather. They've just engineered the balance sheet so they can patiently collect the floating rate interest while the broader market panics.
But this raises an important question for you to mull over as we conclude today. Consider the sheer scope of the operations we've decoded. They are underwriting massive compute-backed loans against physical NVIDIA hardware.
Yeah.
They're establishing dedicated firms with Anthropic to fundamentally rewrite the technological foundations of their borrowers. They are aggressively weaponizing covenants to force private equity sponsors to deleverage. And they're executing sweeping corporate turnarounds using elite former McKinsey executives.
That stretches the definition of a traditional credit fund to its absolute breaking point, doesn't it?
It really does. Are they still just lenders providing capital?
Ah.
Or, utilizing the highly structured vehicle of private credit, have they quietly evolved into the ultimate operational kingmakers of the modern economy?
That is a phenomenal question to leave you with. Thank you for joining us on this deep dive. Keep challenging those surface-level market narratives, look closely at the underlying credit agreements, and always track who actually holds the keys to the capital structure. We will catch you next time.